Our lesson for today will be about financial planning tools and concepts. At the end of this session, you are expected to 1. Identify the steps in the financial planning process. 2. Illustrate the formula and format for the preparation of budgets and projected financial statement. 3. Explain tools in managing cash, receivables, and inventory. Let us talk about the concepts. Financial planning formulates the way in which financial goals are to be achieved. A financial plan is thus a statement of what is to be done in the future. Many decisions have a long lead time, which means they take a long time to implement. In an uncertain world, this requires that decisions made far in advance of their implementation. The planning process begins with a sales forecast for the next 5 or so years. Then, the assets required to meet the sales targets are determined, and decision is made concerning how to finance the required assets. At that point, income statements and statements of financial position can be projected, and the key ratios can be forecasted. Once the base case, forecasted statements and ratios have been prepared, top managers will ask questions such as, are the forecasted results as good as we can realistically expect, and if not, how might we change our operating plans to produce better earnings and a higher stock price? How sure are we that we will be able to achieve the projected results? Projected financial statement method. Step 1. Forecast the income statement. A. Establish a sales projection. B. Prepare the production schedule and project the corresponding production costs, direct materials, direct labor, and overhead. C. Estimate selling and administrative expenses. D. Consider financial expenses, if any. E. Determine the profit. Step 2. Forecast the statement of financial position. A. Project the assets that will be needed to support projected sales. B. Project funds that will be spontaneously generated through accounts payable and accruals, and by retained earnings. C. Project liability and shareholders' equity accounts that will not rise spontaneously with sales, for example, notes payable, long-term bonds, capital, or preference shares and ordinary shares, but may change due to financing decisions that will be made later. D. Determine if additional funds will be needed by using the following formula. Additional required spontaneous increase in funds needed equals increase in retained AFN assets, liabilities, earnings. Step 3. Raising the additional funds needed. The financing decision will consider the following. 1. Target capital structure. 2. Effect of short-term borrowing on its current ratio. 3. Conditions in the debt and equity markets, or 4. Restrictions imposed by existing debt agreements. Step 4. Consider financing feedbacks. Depending on whether additional funds will be borrowed or will be raised through additional capital contribution or ordinary shares, consideration should be given on additional interest expense in the income statement or dividends, thus decreasing the retained earnings. Apply the iteration process using the available financing mix until the AFN would become so small that the forecast can be considered complete. Operating budgets. Role of a budget. A budget is a financial plan of the resources needed to carry out tasks and meet financial goals. It is also a quantitative expression of the goals the organization wishes to achieve and the cost of attaining these goals. The act of preparing a budget is called budgeting. The use of budgets to control a firm's activities is known as budgetary control. Budgets and the budgeting process are intertwined with all aspects of management. In addition to being a plan of operations, a budget plays an important role in allocating resources, coordinating operations, identifying constraints and limitations, and communicating expected actions and results, authorizing activities, motivating and guiding implementation, providing guidelines for control of operations, managing cash flows, and serving as criteria in performance evaluations. Working capital management refers to the efficient and effective utilization of working capital to attain predetermined objectives of the company relative to profitability of operations, liquidity of financial resources, and minimization of risks and company costs. Working capital. Relevance. Working capital is the difference between current assets and current liabilities, or the amount of current assets left after providing for current liabilities. As such, it is the amount of current assets, or the aggregate of cash, marketable securities, receivables, inventories, prepaid expenses, and other current asset items, financed by long-term capital, long-term debt, and shareholders' equity of the business. From the point of view of management, it is the amount of long-term capital that is made to revolve in conducting operations and serves as the lifeblood of the company. Inadequate working capital enhances business failures because of inability to promptly pursue company objectives, inability to take advantage of business opportunities, inability to avail of cash discounts, higher product and service costs, reduced sales volume, loss of customers, and poor credit standing. As the results of all of these, the rate of return on total investments is reduced and employee morale becomes low. Too much working capital, on the other hand, results in inefficient use thereof because it encourages speculation and unnecessary expansion. Management may feel complacent and consequently inefficient, for with too much working capital, they are not under pressure to carefully plan its use. Needless to say, adequate working capital enables a company to pursue its objectives promptly, take advantage of business opportunities, and meet its financial obligations. It also enables management to conduct operations smoothly and lowers cost of capital. Objective of current assets management. The financial managers must carefully allocate resources among the current assets of the firm: cash, marketable securities, accounts receivable, and inventory. In managing current assets, the primary concern should be for safety and liquidity, with secondary attention placed on maximizing profitability. Management of liquidity involved two major decisions. 1. The total amount of liquidity necessary to avoid the risk of insolvency. And 2. The amount of cash versus near cash, marketable securities, to have in the liquidity mix for transaction purposes. Cash conversion cycle. Another important consideration in current assets management is the cash conversion cycle of the company. Cash conversion cycle is the average length of time involved, from the payment of raw materials to the collection of account receivable. This is determined using the following equation. Inventory conversion period equals inventory divided cost of sales per day. Receivables collection period equals receivables divided by sales divided by 360 days. Payable deferral period equals payables divided purchases per day. Tools and techniques. Cash management. Cash management refers to the efficient and effective utilization of cash to attain company objectives. Inasmuch as cash is the item generally used to meet financial requirements of a business, its use must be carefully planned and controlled. Objective of cash management and how it is achieved. The primary objective, cash management, is to plan and control the flow of cash, and this can be achieved by a. Forecasting cash requirements based on the overall corporate plans. B. Determining all the possible sources of cash and the costs involved. C. Accelerating the collection of receivables. D. Instituting control measures over cash receipts. E. Instituting control measures over cash disbursements, thereby being assured that only legitimate obligations are being paid. F. Investing temporarily idle cash in temporary investments to reduce the opportunity cost of capital and raise the actual rate of return. Managing cash flows. The optimal cash balance may be derived with the use of the MPAA following basic approaches, namely: 1. Cash budget. 2. Cash break-even chart. This chart shows the relationship between the company's cash needs and cash sources. It indicates the minimum amount of cash that should be maintained to enable the company to meet its obligations. 3. Optimal cash balance model. In most medium or large-sized corporations, liquidity management has assumed a greater role over the past decade. Since cash is needed for both transactions and precautionary needs in all companies, it must be available in some form: cash, marketable securities, borrowing capacity, all of the time. The liquidity managers must utilize some formal models or techniques to maintain the optimal amount at each moment in time, because too much liquidity brings down the rate of return on total assets employed, and too little jeopardizes the very existence of the firm and sits of the itself. One of the models that can be used to help determine the optimal cash balance is the Baumol model. This model balances the opportunity cost of holding cash against the transaction costs associated with replenishing the cash account by selling off marketable securities, or by borrowing. Receivable management. Receivable management refers to the formulation and administration of plans and policies related to sales on account and ensuring the maintenance of receivables at a predetermined level and their collectability as planned. Objective of receivable management. The objective of receivable management is the achievement of that balance which will result in a combination of turnover and profit rates that will maximize the overall return on investment in a business entity. In other words, there must be effective credit and collection policies to maximize the return on investment in the firm. The gross margin on sales on account is generally higher as compared to that on cash sales, so that the rate of return on sales on account must be higher also. However, a lenient credit extension policy inflates receivables and may result in greater cost of collection, clerical cost of maintaining customers' accounts, bad debt losses, and opportunity cost on capital tied up in receivables. Management must therefore be in a position to determine the happy medium between the two, so that higher profit margins are availed of and, at the same time, costs incidental to the maintenance of receivables are minimized. Summary of trade-offs in credit and collection policies. Shown below is a summary of the cost-benefit relationship that will result upon application of factors affecting the credit and collection policies. Aids in the analysis of investment in accounts receivable. A. Ratio of accounts receivable to net credit sales. A level of investment in trade receivables can be expected to fluctuate with the volume of credit sales, provided sales terms and collection practices remain the same. It is for this reason that the ratio of accounts receivable to net credit sales may be used in determining whether a company has become lenient or strict in its credit and collection policies and procedures. B. Receivable turnover and average collection period, or number of days sales in accounts receivable. Aging of accounts receivable refers to the method of sorting the receivables by the due date, to estimate the bad debts expense to the business firm. Inventory management refers to the formulation and administration of plans and policies to efficiently and satisfactorily meet manufacturing and merchandising requirements to minimize total costs relative to inventories. Objective of inventory management. The primary aim of inventory management is to maintain inventory at a level which best reconciles turnover and profit considerations, and consequently maximize return on investment. A high inventory rate may indicate an underinvestment in inventory and vice versa. An underinvestment in inventory requires that purchase be made more often, so that it brings with it the disadvantage of higher carrying costs and greater risk from stockouts. Stockout, in turn, may cause loss of customers, decline in sales volume, and consequently, a decline in a company's goodwill. To service customers promptly, inventory should be maintained at a level that will minimize the possibility of stockouts. However, overinvestment in inventory must also be avoided because it requires greater carrying costs arising from the need for more storage facilities, the risk of loss from obsolescence, spoilage, and price declines, and the cost of capital tied up in inventory. Aids in the analysis of investment in inventory.
Inventory management techniques. A. Inventory planning. Inventory planning involves the determination of what inventory quality, quantity, timing, and location should be in order to meet future business requirements. The approach and mathematical techniques that may be used in determining inventory order, size, timing, etc. include EOQ model, reorder point. B. Inventory control systems. Inventory control is the regulation of inventory within predetermined limits. Effective inventory management should provide adequate stocks to meet the requirements of the business, while at the same time keeping the required investment to a minimum.